Welcome back to Coffee with CRS. I'm Jody, and I'm here with Paul. And today we're talking about some of the fine print in the big, beautiful bill, changes to the SALT deduction, eliminated credits, and a few other updates that might surprise you. Paul, let's start with SALT deduction. What's changed?
The SALT deduction, which stands for state and local taxes, has been a hot topic for the last few years. The big news is that for 2025, the cap jumps from 10,000 to 40,000, and it'll go up a bit more in 26 and for the next few years until 2030, where it drops back to 10,000. So for the next few years, people in high tax states can deduct a lot more of their state and local taxes.
That's a big jump, but is there a catch?
There's always a catch, right? If your modified adjusted gross income is over 500,000 in 2025, the deduction starts to phase out. So high earners still have a limit, but they'll never go less than 10,000.
And what about small businesses? I've heard about the PTET Workaround. Is that still a thing?
It is. For most businesses, the pass-through entity tax PTET Workaround is still available for entities like S-corps and partnerships.
What about credits? Are there any that are going away?
Some green energy credits are being eliminated after 2025. So if you're thinking about solar panels or energy efficient upgrades, now's the time, because after this year, those credits are gone.
Okay, so if I want to install solar panels, I better get on it in the next few weeks.
Yep.
Any other deductions or credits we should know about?
Yeah, there's a few. Most miscellaneous itemized deductions are now permanently suspended, except for unreimbursed educator expenses, which teachers can still deduct. There's also a new rule for charitable deductions starting in 2026. You can only deduct the amount above 0.5% of your AGI. That means even if you itemize, the first 0.5% of your adjusted gross income that is donated is not deductible.
Okay.
So for example, say your AGI is $200,000, that means the first 1,000 or 0.5% of 200,000 in charitable contributions is not deductible.
What about casualty losses? I know that's been a big deal for people hit by disasters.
Indeed. The deduction for personal casualty losses is now permanently limited to losses from federally or certain state declared disasters. So if your loss isn't tied to a declared disaster, can't deduct it anymore.
Man, any new deductions we should be excited about?
Yes. There's a temporary deduction up to $25,000 for qualified cash tips and $12,500 of overtime pay through 2028.
Wow.
And for the first time, you can deduct $12,500 of interest paid on qualified new personal use vehicles. So if you're already buying a new car, that's a bonus.
Wonderful. And what's the standard deduction?
It's going up. For 2025, it's $31,500 for joint filers, $23,625 for heads of household, and $15,750 for singles. Plus, the limitation on itemized deductions is gone for good, replaced by a simpler 2% reduction formula for high-income taxpayers.
Simpler. I love that. So, to sum up, bigger SALT deductions for now. Some credits and deductions are out, but there are a few new perks, especially for people who work for tips, overtime, or buying a new car.
That's right. Fine print matters, so it's worth checking what's in and what's out for your situation.
Thanks, Paul. Next time, we'll wrap up the series with practical planning tips for individuals and small businesses. You don't want to miss this.